The global financial system is holding $500 trillion in debt, half a quadrillion. And right now, in boardrooms from New York to Frankfurt to Tokyo, the people who manage this debt are starting to realize something terrifying. The math doesn't work anymore. This isn't a conspiracy. This isn't fear-mongering. This is the documented reality of a credit system that has one fundamental requirement. It must grow forever. And when something must grow forever, eventually it hits a wall. History shows us this pattern repeating across centuries. The South Sea Bubble, the Panic of 1893, the Great Depression, the 2008 financial crisis. Every single time, the mechanism is the same. Credit expands beyond the real economy's ability to service it. Then something breaks. But this time is different in scale, because this time, the debt isn't just in one country or one sector, it's everywhere. Sovereign nations borrowing to pay interest on previous borrowing. Corporations leveraged to unprecedented multiples. Consumers drowning in credit card balances, auto loans, and mortgages they were told they could afford. And beneath all of it, hidden in what analysts call the shadow banking system, lies leverage that nobody can accurately measure. Let's start with what we can see. Global government debt now exceeds $90 trillion. Corporate debt sits around $85 trillion. Household debt, another $60 trillion. Add it together, and you're already past $200 trillion. But that's just the surface. Many economists argue the real number, when you include derivatives, pension obligations, and off-balance sheet liabilities, pushes past $500 trillion. Some estimates go higher. For decades, this worked, because interest rates kept falling. When you borrow money at 5% and refinance at 3%, suddenly your debt becomes easier to manage. You can borrow more, and that's exactly what happened. From the early 1980s until 2021, interest rates fell in a nearly unbroken trend. 40 years of cheaper and cheaper money, 40 years of being able to roll over debt at lower and lower costs. But then something changed. Inflation returned. Not the gentle 2% kind that central banks like to maintain. Real inflation, the kind that forces grocery prices up 20% in 2 years. The kind that makes rent unaffordable and pushes gasoline past $5 a gallon. And when inflation comes back, central banks have one tool. They raise interest rates. The Federal Reserve pushed rates from near zero to over 5% in less than 18 months, the fastest hiking cycle in 4 decades. The European Central Bank followed. The Bank of England followed. Suddenly, all that debt that was easy to service at 2% became crushing at 5%. And here's where the fragility reveals itself. Every percentage point increase in interest rates adds trillions in annual debt service costs. Governments that were paying $300 billion in interest are now paying $800 billion. Corporations that could comfortably cover their debt payments are now choosing between paying bondholders and investing in growth. Consumers who stretched to buy homes with 3% mortgages are watching their neighbors try to enter the market with 7% rates and realizing the entire housing market has frozen. But the real danger isn't in the debt you can see. It's in the shadow banking system. This is the world of private credit funds, collateralized loan obligations, repurchase agreements, and derivatives chains that span the globe. Analysts suggest the shadow banking sector now holds assets worth over $200 trillion. That's 3 times the size of traditional banking. And unlike traditional banks, which face strict regulations and oversight, shadow banks operate with minimal scrutiny. Here's how leverage works in that world. A hedge fund might put up $1 of actual capital. They use that dollar as collateral to borrow $10. They use that $10 to buy an asset. Then they use that asset as collateral to borrow against again. Suddenly, that $1 is controlling $30 or $40 worth of positions. This is called rehypothecation. The same collateral gets pledged over and over in a chain of borrowing that works perfectly as long as asset prices keep rising. But if prices fall, that chain breaks. The hedge fund gets a margin call. They need to post more collateral or sell assets. But everyone else is getting the same margin call at the same time, so they all try to sell at once. Prices fall further. More margin calls, more forced selling. This is a liquidity crisis. And history shows us that when liquidity crises hit the shadow banking system, they spread to traditional banks within days. 2008 started exactly this way. It began with subprime mortgages, a relatively small corner of the financial system. But those mortgages had been sliced up, repackaged, and sold as securities. Those securities were used as collateral for other borrowing. When housing prices stopped rising, the entire chain seized up. Bear Stearns collapsed, Lehman Brothers collapsed. AIG needed a bailout. Money market funds broke the buck. Within weeks, the global financial system was hours away from complete shutdown. Governments responded with trillions in bailouts and stimulus. Central banks dropped interest rates to zero and started buying assets directly. Quantitative easing, they called it. And it worked in the sense that it prevented total collapse. But it also created the conditions for what we're seeing now. Because all that money, all that liquidity, didn't go to workers or small businesses. It went into asset prices. Stock markets tripled. Real estate markets soared. The wealthy, who own most of those assets, got dramatically wealthier. The middle class, who rely on wages, got left behind. If current trends continue, many economists argue we're heading toward a similar crisis, but with one critical difference. Central banks have already used their ammunition. Interest rates can't go much lower from 5% before they hit zero. Balance sheets are already bloated. The tools that worked in 2008 might not work in 2024 or 2025. So what breaks first? Analysts watching the system point to several candidates. Commercial real estate is already showing cracks. Office buildings sit half empty as remote work becomes permanent. Property values are falling. Banks that lent against those properties are sitting on losses they haven't recognized yet. Regional banks in particular are exposed. We saw the beginning of this with Silicon Valley Bank and First Republic in 2023. But the problem is much bigger than two banks. Then there's the corporate debt market. During the low-rate era, companies borrowed staggering amounts, not to invest in productive capacity, but to buy back their own stock and pay dividends. Now rates are higher, and those debts need to be refinanced. Companies that borrowed at 3% are rolling over at 7%. Some can't afford it. Corporate bankruptcies are already rising. If that accelerates, we see job losses, which means consumer spending falls, which means more companies struggle. A feedback loop. Consumer debt tells a similar story. Credit card balances in the United States recently crossed $1.2 trillion. Student loan debt sits at $1.7 trillion. Auto loan delinquencies are rising. Many households are now in what analysts call survival mode, paying minimum balances and hoping something changes. But if unemployment rises even slightly, those delinquencies turn into defaults. Banks tighten lending, consumers pull back spending, the economy contracts, and then there's sovereign debt. Countries like Japan, Italy, and the United States are running debt-to-GDP ratios above 100%. That means they owe more than their entire economy produces in a year. This only works if lenders believe they'll get paid back. That belief rests on the assumption that economies will keep growing and governments can keep borrowing. But if growth slows and interest costs keep rising, at some point the math becomes impossible. Bond markets start demanding higher yields to compensate for risk. Higher yields make the debt even more expensive. Another feedback loop. History shows us what happens when sovereign debt spirals out of control. Sometimes it ends in default, like Argentina or Greece. Sometimes it ends in hyperinflation, like Weimar Germany or Zimbabwe. When governments print money to pay debts and destroy the currency's value, sometimes it ends in austerity, where governments slash spending, cut social programs, and trigger depressions. None of these options are pleasant. The people who manage the global financial system know all of this. They're not stupid, but they're trapped. If they raise interest rates to fight inflation, they risk breaking the debt markets. If they lower interest rates to help borrowers, inflation stays elevated and erodes purchasing power. If they try to hold rates steady, they hope everything stabilizes on its own. That's where we are now. But here's what makes this moment different from past crises. The speed. Information moves instantly. Markets are globally interconnected. Algorithmic trading means that once selling starts, computers amplify it. A crisis that might have unfolded over months in 1930 or even weeks in 2008 could now unfold in days or hours. Flash crashes aren't anomalies anymore. They're warnings. So what does a cascading liquidity crisis actually look like? It starts in a corner of the market that seems disconnected from everyday life. Maybe it's a private credit fund that can't meet redemptions. Maybe it's a European bank with exposure to commercial real estate. Maybe it's a developing country that defaults on dollar-denominated debt. The specific trigger doesn't matter. What matters is that once something breaks, fear spreads. Investors start asking questions. Who else is exposed? What other assets are overvalued? Better to sell now and ask questions later. So they sell. Prices fall. Margin calls go out. Forced selling begins. Credit markets freeze because nobody wants to lend when they don't know who's going to survive. Companies that rely on rolling over short-term debt suddenly can't. They start laying off workers to conserve cash. Banks, seeing loan defaults rise, tighten lending standards. Small businesses can't get working capital. They lay off workers. Unemployment rises. Consumer spending falls. More companies struggle. More defaults, more bank losses. If it gets bad enough, you see bank runs. People line up to withdraw deposits because they're afraid their bank might fail. Governments step in with deposit guarantees, but if the crisis is big enough, those guarantees get tested. Stock markets plunge, retirement accounts lose value. The wealth effect reverses. People who felt comfortable spending because their home and portfolio were worth a lot suddenly feel poor and scared. They cut back on everything except essentials. Restaurants empty out, travel stops, luxury goods sit unsold. The economy contracts sharply, and here's what analysts worry about most. In past crises, the wealthy had enough cash or access to credit to buy assets at fire sale prices. Stocks, real estate, businesses, all available at massive discounts. But they could only do that because central banks provided the liquidity. If central banks can't or won't provide that liquidity this time, even the wealthy face losses. But make no mistake, when assets go on sale, those with cash and access still end up owning more of the economy than before. The middle class, living paycheck to paycheck, can't buy anything. They just survive the downturn and come out the other side with less. This is the mechanism of wealth concentration during crises. It's happened repeatedly throughout history. The Panic of 1893 wiped out farmers and small banks, while J.P. Morgan consolidated power. The Great Depression destroyed middle-class savings, while the wealthy bought assets for pennies. The 2008 crisis saw Wall Street firms bailed out, while millions lost their homes. The pattern repeats because the structure of the system allows it. So what survives? Cash survives, at least initially. Though if inflation returns or currency crises hit, even cash loses value. Hard assets with no debt against them survive. A home you own outright. Productive land, skills and education that remain valuable regardless of economic conditions. Social networks and community connections that help people weather hardship. These things don't show up on balance sheets, but they matter when systems break. What doesn't survive? Over-leveraged investments. Companies with unsustainable debt loads, jobs in discretionary sectors, retirement plans that assume perpetual market growth, the assumption that housing prices always go up, the belief that government programs will always be there. These things get tested when the math stops working, and make no mistake, the math is stopping. You can't grow debt faster than the economy forever. You can't keep leverage multiples expanding indefinitely. You can't pretend that $500 trillion in obligations can be serviced by a global economy that produces $100 trillion in output. At some point, reality asserts itself. Many economists argue that point is approaching faster than most people realize. The signs are there for anyone willing to look. Rising default rates, inverted yield curves, credit spread widening, bank failures, government debt auctions that struggle to find buyers. These aren't theoretical concerns. They're happening now. The question isn't whether the system reaches a breaking point. The question is when and how severe the consequences will be. Will it be a managed reset, where governments coordinate to restructure debt and write down obligations in an orderly way? Possible, but history suggests that coordinated action is difficult when national interests conflict. Will it be a chaotic collapse, where markets seize up and governments respond with emergency measures that may or may not work? More likely, based on how past crises have unfolded, or will it be something in between? A rolling crisis where different sectors and countries break at different times, creating years of instability and uncertainty. That might be the most probable outcome, not a single catastrophic event, but a grinding deterioration of living standards as debt burdens grow. Productivity stagnates, and the gap between asset owners and everyone else widens. For everyday people, the implications are profound. If you're carrying debt, especially variable rate debt, you're vulnerable to interest rate spikes. If your job is in a discretionary sector, you're vulnerable to spending cutbacks. If your savings are in assets that rely on leverage and confidence, you're vulnerable to price crashes. If you're depending on government programs or pension promises, you're vulnerable to austerity and benefit cuts. But awareness is the first step toward action. Understanding that the system is fragile means you can prepare, reduce debt where possible, build emergency savings, develop skills that remain valuable in downturns, invest in relationships and community. Don't assume that what worked for the last 40 years will keep working for the next 40. The low rate, high leverage, ever-growing debt world is ending. Something else is coming. And here's the difficult truth that nobody in power wants to say out loud. The only way to resolve $500 trillion in debt is through some combination of default, inflation, or austerity. Someone is going to take losses. The fight happening now, beneath the surface of policy debates and economic forecasts, is over who bears those losses. Will it be creditors through defaults? Will it be savers through inflation? Will it be citizens through cut services and higher taxes? History shows that the people with the least power bear the largest share of the burden. The middle class gets squeezed. The poor get devastated. The wealthy, with their assets, mobility, and political influence, find ways to protect themselves. This isn't a moral judgment. It's an observation of pattern. And if current trends continue, this pattern is about to repeat on a scale larger than any previous crisis. The $500 trillion debt time bomb isn't hidden. It's documented in central bank reports, IMF assessments, and academic papers. The people managing the system know it exists. They're hoping that growth returns, that inflation moderates, that interest rates can stay in a sweet spot that keeps everything functioning. They're hoping that technology or productivity gains or some other factor changes the equation. Hope is not a strategy. What comes next will reshape the global economy for decades. Fortunes will be made and lost. Power will shift. The social contract between governments and citizens will be tested. And through it all, the fundamental lesson remains the same. A system built on perpetual credit expansion eventually reaches its mathematical limits. When it does, the consequences are never evenly distributed. Understanding this doesn't mean you can avoid all impact, but it means you can prepare, adapt, and perhaps come through the other side in a position to rebuild something better. The clock is ticking. The debt is growing. The interest costs are rising. And somewhere, in a corner of the financial system that most people have never heard of, the first crack is already forming.